And you're live.
Thank you. So we are calling the meeting of the Police and Fire Retirement Commission to order. A quorum is present. And with that, we will proceed with the agenda, which I believe has been published. This is a public session and it is being recorded, is my understanding. The first item of business was to review the minutes of the last meeting, which were circulated. Are there any comments on those minutes, or can we have a motion to approve the same?
Move approval.
Second.
Those in favor, say aye.
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 Any opposed? Any discussion? And if not, those minutes are accepted, both of the general meeting. And Ross, may I assume you also included approval of the executive session?
You may do that.
Okay, and again, if there's any comments on one or the other, otherwise they are accepted. We are going to begin the meeting in open session and address the topic of general market conditions. When we go to discuss the performance of individual managers and what we are doing with individual managers, we will go back into we will go into executive session at that point. Mr. Jones, good morning. Right. Welcome.
Good morning, and thank you everyone again for helping me this morning. I had a Sibley Hospital meeting and it did run past 8:30. So from an investment standpoint, the agenda topics are a review of the market environment and then the performance of the retirement plan in total. And then some items that we chatted about in prior meetings was potential adjustments to the current asset allocation targets. The concept of potentially raising additional cash for benefit payments and operating needs. We're going to review the current allocations to small and mid cap and talk about active versus passive management. And then something which we touched on at the last meeting was what does the future look like from a capital market assumption standpoint? And we've got some material on that. So first, in looking at the markets, we put together a flash report as of November 30, and there's actually been a lot of activity since November 30, if you look at the investment markets over the past week or so. But year to date through the end of November, we continue to have really strong results in domestic equities, U.S. equities. The S&P 500 was up more than 23%. And we had great absolute returns from mid and small cap represented by the Russell indices, but they trailed large cap. You can see the Russell mid cap index was up just under 18, and the Russell 2000, which is representative of the smallest companies, was up about 12.3%. One of the noteworthy factors that has happened over the past several months, couple quarters, is a rotation away from value to growth. If you recall, 2020 was dominated by growth. At the end of 2020, we saw a rotation from growth to value, and value led, leading into the second quarter of 2021. But then we've seen growth come back. And if you look at that year-to-date number, the Russell Growth Index is up about 25% year-to-date, and the value index is up 17.75%. As a result, it's been hard for many active managers to add value relative to the indices. It's been hard for them to anticipate this rotation and the relative narrow leadership that has come with this rotation. So what I have seen in the performance that I've reported as of November 30 is that many active managers have trailed their benchmarks through the end of November. The international markets have been more challenging. The MSCI EAFE index, which is representative of developed countries, is up 5.8% through the end of November. You'll see in a minute, though, that that benchmark has done better over the last couple of days. And the emerging markets have had challenging results, negative 4.3%. And one factor which has had an impact on the emerging markets is China. And the government has issued some regulatory reform within China, which has impacted some industries and companies. And China is the biggest component of the emerging market index, so that has had an impact on the emerging markets in general. The fixed income markets have been challenged because of rising interest rates. And you can see the US aggregate index year to date was down about 1.3%. The investment grade corporate market was down about 1%. Interestingly, the higher yielding, lower quality part of our US fixed income markets, the high yield index, has actually had a positive return, up 3.3%. And so they benefited from a higher yield in general, but also not until recently, we haven't seen the same interest rate increases, but recently yields rose within the high yield market. So we've seen negative returns coming from high yield over the past 3 months. And then global bonds have been the most challenged, down 4.5% through the end of November. So what I did this morning, I updated.
And if you would go back a moment, the yield to worst on the fixed income.
Yeah.
What is that measuring?
So yield to worst is a fancy phrase for yield to maturity. And yield to maturity is based upon all the bonds in the index, the coupons attached to those bonds, and the current value or price that the bonds are selling at. If you hold the US aggregate index, and it has an average maturity of about 8 years, and if you hold all the bonds in that index, it is anticipated that your yield to maturity will be about 1.7%. And that's really just tied to the math. I would never bet on the equity market in terms of what returns will be, but I would more likely bet on the fixed income markets because you know the bonds and you know their coupons, you know the current price they're selling at. And what the word worst comes from is that some bonds have what's called an optionality. A corporate bond may have the ability to call back their bonds, and the yield to worst takes into account the optionality that a bond might have. So it's sort of like worst case scenario. Worst case scenario with the Barclay US aggregate index, if all those bonds are called back that have that optionality, you're going to get about 1.7% over the next 8 years from the US aggregate index. In the corporate investment grade, you're going to get about 2.3. High yield, you're going to get about 4.8, and global bonds, 1.2. So the takeaway here is that with bond allocations, if you've got a actuarial interest rate assumption, 7.5, 8%, bottom line is that your bond allocation, if it's in investment grade, high quality US bonds, you're not going to get there over the foreseeable future with a bond allocation. Long-winded answer, but I think a good discussion. It's something that we have been discussing with you, but also other clients, is that yield environment is a challenge for benefit plans that need to earn considerably higher returns. Any other questions? So we we ran performance through close of business yesterday, and what a difference a week makes. So if you look under MTD, that's month to date. That is the month of December. So you can see all of the equity market benchmarks have had positive returns in the month of December. And then you look at year to date, and large cap is up now 26.5% at the S&P 500 through yesterday. The S&P 400 is up almost 23%, small cap of 15 and change. You saw better performance over the last week from value. You can see the value index is up 3.57. The growth is up 1.5% roughly. So still growth is leading year to date, but the delta is a little bit less. And you've seen pretty good performance over the last week from developed international, up 3.33%, and now up 9.3% year to date. Bond market still negative territory, and you've actually had a rally in high yield bonds. They returned 1.2% over the past 7 days, and you've had a slightly negative return from the aggregate bond index. I think another interesting, if you look at those FANG stocks, FANG stocks are stocks like Facebook, Amazon, Netflix, Microsoft, Apple, and Google. Under the year-to-date column, you look at some of them, Microsoft up 51, almost 52, Apple up 30, and Alphabet, Google, up almost 70% year-to-date. Those are some of the biggest names in the index, and they've had a material impact on index performance. Any questions on the market environment? Joe, I was now going to go to the plan, the manager allocations.
Yeah, at this point, I would take a motion to move into executive session.
So move.
A second?
Second.
Got a second? Anyone opposed? Given that I assume the others are in favor? Yes. We will now move into executive session.
Okay, stand